Welcome, everyone. Thank you for joining us for this month's State of Freight webinar. My name is Brittany Chisnall with the FreightWaves media team, and I'll be your host for today. I'm happy to be joined today by FreightWaves founder and CEO, Craig Fuller, and SONAR's head of freight market intelligence, Zach Strickland, with additional insights from JP Hampstead, strategic analyst at FreightWaves. Today's conversation will cover the latest insights from SONAR, current market trends, and insights from our experts. Craig and Zach will also be answering any questions live following our discussion. Before we get started, I'd like to cover just a couple of quick items. First, if you have any issues during the webinar, please feel free to reach out to our team via the group chat function in your webinar console. If you have questions that you would like to ask our experts, please enter those through the Q&A box in your console at any point during our conversation today. We will answer as many of those as possible during that live Q&A. We'll also be sending a link to the recording of this webinar tomorrow if you'd like to view it on demand or share it with your colleagues. At this point, I'll go ahead and turn it over to Zach to kick off today's discussion. Zach, let's jump right in.
Thank you for that, Riel, and thank you to everybody who is tuning in at our new standing State of Freight webinar here. Craig Fuller, founder and CEO, is standing in front of probably the single most important chart in transportation right now, the S-Tri, Craig, which is, we always kind of talk about tender rejection rates, but I don't think we really hone in on their value point in terms of like why they're kind of a clean signal of the market turning.
Well, the way tender rejections work is all based on something called the waterfall. And this is sort of the waterfall theory of freight, which is that the largest motor carriers set the tone for the entire market. Right. So the largest shippers and the largest motor carriers have an outsized influence on the direction of the capacity in the market or direction of demand. So if you're a big shipper, you're going to want to do business typically with a set of large carriers in addition to small carriers or brokers. You typically have these core carriers that you do business with that even when the market rates soften, you're reluctant to pull freight from them because when you need a lot of additional trucks, right, a surge or a project, you can rely upon the bigger guys easier than you can typically rely on a lot of small guys. And so what we look at is tender rejections are message flows from shippers to carriers, and they tell us whether or not the carrier is. So there's the volume side of it, which is tender volume. The tender rejection tells us whether or not the carrier is willing to take that load. Do they have the capacity to take it? Do they want to take it? There's a lot of reasons that carriers will reject freight. Could be they don't have a truck for that lane. They don't want to go to that part of the country. It could be a service requirement issue. Maybe they can't meet the service requirements. Could be a breakdown. But a lot of times when you look at it on a whole market basis, because we're not talking about one trucking company, right, we're talking about the entire market, we're trying to understand what is the market communicating to us, which is why these national indexes, and even by a lane basis across the market, is really important. So what this is actually communicating to us, and I'll quote Ben Murphy, the late Ben Murphy, who was my co-founder at FreightWaves, is that ultimately this shows optionality. Our motor carriers, our fleets communicating that they have something better to do with that truck. And therefore, the more rejections, the more basically the more pricing power they gain and the more optionality they have for something to do with that truck.
Right.
No different than a tender app.
Right.
The more you rejected, the more
options.
The more options. The more selective you are, we'll say, and that's exactly the way our tender rejection data works. Is the more rejections I get, basically the more options I have available to me.
So also, a carrier is not going to just simply reject business and let a truck sit there, correct?
Correct. So they're typically rejecting because they have demand somewhere else.
Right.
And that is the primary reason. It could be they don't like the rates, but oftentimes it's because they have something better to do with that truck, a higher paying load. And it could be that one of their largest customers called in for 10 times as many loads. Right. If you do business with Walmart, Walmart's on the phone with your largest customer, Walmart can say, hey, I know I'm giving you 10 loads, 10 trucks or 10 loads on this lane. I need 100. And you can only push back so far on a company like Walmart if it's your largest client.
Right.
And before they're going to be like, no, dog, you're taking this whether you like it or not. And then all of a sudden you're rejecting everything else. But at a market level, at its most fundamental principle, what a high rejection rate, an increasing rejection rate tells us that motor carriers are gaining pricing power and optionality. In other words, they have more freight than they did if the rate, the tender rejection is going up. That means that they are gaining pricing power and they have more freight to choose from for those trucks than they did the day before or in that prior period.
And we've been averaging about a 4 to 5% rejection rate.
Yeah, if you look down here at a relatively low rejection, this is 5%, this is 13.35%. Basically, if you go back, Zach, if you scoot a little bit back here, let's show where we were last April. We were down, if you go back a couple of years ago, we were in the 2.5% levels. Look at how far we've come. So this was May was the low of 2023. That was the Great Freight Recession low. And basically we have climbed and clawed and come all the way back up here. Even when the freight recession has been going on in 24 and 25, we have seen really since November this massive surge in rejections.
Right.
That puts us where we're at today, which is 13.35%.
Yeah, and of course we have these seasonal moments where you see these spikes, but none of them look quite like what we're seeing right now.
Not at all.
Yeah.
I mean, if we can zoom into this, and we want to show you zoomed in what this looks like. So we started to see in August, we started to see that tender rejections started to cook a little bit right before Labor Day, coming into this Labor Day season. All of a sudden in October was when we started to see the surge. And you may remember this. It was early October. You and I were on the phone. It was late September, early October. And we were seeing something really interesting develop in the market we hadn't seen before.
Right.
Which was this spot rates were starting to cook up.
Yep.
But tender rejections were not actually moving. And so we were seeing an interesting development happen in the market where tender rejections were cooking up, were melting up. Rates were melting up, and tender rejections were actually staying quite flat.
Right.
And it was weird because we don't typically see that. We don't see them diverge that much. But what it was communicating to me was that some of those bottom feeders, some of those really cheap motor carriers that were being shut down by this immigration crackdown and compliance crackdown were effectively being eliminated from the market. So if the lowest price carriers are being eliminated, your average is naturally going to go up, and that's what we saw in spot rates. And now, if we fast forward a couple months later, we've seen rejection rates just continue to go hyperbolic relative to where they were.
And the fact that we're seeing this shape where, you see these seasonal peaks, around Christmas, New Year's, okay, the carriers are on holiday. They're not basically working or the networks are broken, et cetera. We don't normally see it jump up and then kind of stick very often, correct?
Well, I think, look, the momentum, it's interesting because there's arguments on X and look, it's a bunch of opinions and I know that sometimes people don't want to hear mine, sometimes people don't want to hear those.
Opinions are free.
Opinions are free, as well as other things. Everybody's got one. And the reality is we can still have a strong market but not have this upward momentum, if you will. And it is fair to say that our momentum has been softened, or we've lost some upward momentum short term.
Sure.
But effectively, we're just consolidating. I mean, if you look at the fact that we're still well above 13%.
Well, the market we don't have to see.
It's not going to go in continuously. And by the way, it will never go below 0, never go below 100%. It's all percentage. But the fact that we're at 13%, I'm going to quote Derek Leathers, the CEO of Werner, one of the best truckload operators out there, actually stated that, quoted at a Stifel conference, that rejection rates in the 13 to 14% is very much COVID-like.
Yeah.
And he's not wrong. In fact, Will, if we could zoom out a bit and go and look at actually go to an all chart, is you see that if you go back to COVID, we dipped. Gosh, I think that was 2% or something in the sort of COVID cycle. Yeah. It shot up the toilet paper. This was the toilet paper crisis. That was the toilet paper crisis of 2020. But this was the COVID peak, and we're at 25%. But what I think we're seeing is this massive, massive increase that this chart in terms of acceleration is certainly there. And I think the most important thing is the context.
Yeah.
We are in the third week of March. Typically a decent time of year,
right,
but not a great time of year. In fact, we saw our great tender rejection. Let's zoom in on this, Will. Our biggest spikes in tender rejections that we've seen in the last couple of months actually took place in the worst time of year, which was January and February of the year. And so the fact that tender rejections stayed very stable, high in the month of February, because you can look at it, once we hit February, we got to 13%. We have not looked back.
Yeah, and like you said, February is typically dead time. We talked about this on the last State of Freight. Like, I think still most of us, including myself, I thought we would see a little bit of a sharper downturn on the rejection index because it is that quiet time of the year.
It's also important to remember that we had weather in late January.
Yep.
It was around, I believe it was Martin Luther King Day. It was that week of MLK. And this was the low in January. Shot up since then. And there was an argument going on about whether, or sort of a thesis on whether this is weather related, no pun intended, or something more fundamental. We are now 6 weeks, maybe even 7 weeks past that weather event at this point. It is very clear to me, yes, there's been weather, there's been some storms in the Northeast that have played out. But those things are not sort of market-wide problems. And the fact that we're still having high sustainable rejection rates means that there's something very substantial happening in the market.
Yeah, and you mentioned the tender rejection rates are very focused on that contract relationship between shipper and carrier. Let's pull up the NTI, Will, and look at the spot rates, because there's a lot of correlation here. But I think there's a nuance as well that we should talk about when we pull up the spot rate chart for dry van loads in the United States, NTI.USA. So small carrier centric, a lot of brokers, 3PLs involved in this market. The spot market represents somewhere between 20 to 30% of the overall freight volume, give or take, depending on the market. The fact that we're seeing this index do the same thing, kind of like, there's almost like an indecision point in February, and it starts to pop back up. Craig,
I think what's more interesting is that this is a new cycle high, 282.
Exactly.
Is the highest level it's been. If you zoom out to 5 years on this, Will, we're basically at levels. If you look at this green line, it's one of the things I love about SONAR's charts that makes it very easy to interpret data. That green line tells you where we're at, 282. By the way, we have large font, so that it looks like it's higher. It actually isn't, just the way that the font is so thick inside of that. But you can see that really that 281 and 282 are the high levels that we've seen in the entire cycle for the Great Freight Recession, really since 2022. Since the freight recession started. And this was, by the way, this is holiday, so you have to sort of ignore that as a seasonal high. Our spot rates are always
we were coming out of this period, and there's a little bit of...
If you look at it, Zach, we're back to where we were at the start of the freight recession.
Yeah.
And what I think is really interesting is we've cycled now back, and we're threatening new highs. In fact, I am curious over the next couple of days if we will get new highs. I believe we will, frankly, because we're moving into the later part of March. And capacity continues to tighten.
Right.
I believe we will see new highs. We've had some consolidation in recent weeks.
Now, we have to talk about fuel being included in this figure, though.
So fuel is included. The important, so it's interesting because a lot of the public stocks have sold off, and we have some folks that on Wall Street that watch this show. There is a misinterpretation. If we pull up NTIL, because this is a stripped out component of diesel taken out. I want to be clear on this because it gets very confused. This is a made up number, and I want to explain why it's made up. It's not that we've artificially created it, but we calculate the net line haul with diesel taking out. So the calculation is pretty simple. It's NTI.USA, which are actual transactions.
Yep.
So those come in every single day within basically every night. We have 65 of the top 100 brokers that send this data into us every day. They're all under the same set of rules. They send those transactions, and then we calculate what we estimate the fuel to be at 6.5 miles per gallon. And we strip that out, and what this tells us is really the cash flow for the motor carrier. And the problem is Wall Street is so obsessed with, and like truck stop does the same thing, and we all use a slightly different fuel surcharge variable. Like we're calculating fuel a little bit differently, but truck stop does it. They're on the Bloomberg terminal. DAT does it. We do it, and it's sort of a made-up number at the end of the day, and it's irrelevant because it doesn't actually tell us anything about the market. It tells us how much cash flow small carriers get, but it doesn't actually tell us about the market conditions.
Right.
Because ultimately what really matters is that gross line haul rate at 282 a mile, not this net rate at 206, because as fuel peaks, as fuel has increased, and we've seen fuel prices accelerate, that is going to beat that number down until the market can sort of catch up. And so
in a fast fuel rate moving environment like we have, we're probably calculating the influence of fuel on transportation costs faster than we should, because these carriers are filling up. They're not necessarily filling up as fuel is going up in this speed, especially the loads they're
filling up every 2 to 3 days. So I don't know if the speed is as much as a relevant factor as it is more of a factor that's not actual number. And the fact is that 80% of all truckload transactions have fuel surcharges connected to them. And that fuel surcharge, even so if you're contracted freight, and let's say, you said, we're talking about broker freight being 20 to 30% of the market, spot is anywhere from 15 to 20%. Even broker freight, a lot of broker freight has fuel surcharges. The contracted broker freight has fuel surcharges. And so as fuel surcharge is actually charged on top of the rate. So what that enables motor carriers to do, or anybody benefiting from fuel surcharge, including brokers, is to offset that fuel increase. And so what I tend to look at is if I want to understand the cash flow of small carriers, then I will look at this NTIL data, because that gives me the cash flow of the motor carriers. But if I want to understand market conditions, this is an irrelevant data point. It is NTI.USA, and it is the gross rate that is far more relevant to the market than this is, because if we go back to NTI.USA, finding what the market price is clearing out is important. The net of fuel is not a market data point.
Well, the purpose of the NTIL is to remove the volatility signals in fuel, because you can measure that independently.
That's right.
This is the way to look at, because carriers or shippers are quoted all-in rates on the spot market because they have all the information they need.
That's right. They're quoted at the time of booking, 2 to 3 days ahead of when they pick up, sometimes shorter, sometimes longer. The price of fuel is reflected at the moment, effectively the moment when that transaction is to clear. You have an idea what the fuel is at. And so it doesn't move around a whole lot. In the last couple of days, it's moved around a whole lot because of this Iran war that we're in. But as it relates to market conditions, and I was talking to a trader on Wall Street over on X, who they work for a big firm. I don't know which firm because they never reveal. And he was asking questions about this, and he was saying internally at their firm, they're very obsessed with that net fuel data. And they're looking at the truck stop rate that's on the Bloomberg terminal. And if we pull up NTIL again, Will, and we're bouncing around here a bit, but I think it's important. And let's zoom into a 1 month chart on this. It looks a lot more dramatic. And like, oh my God, the freight market is falling apart. We're down 11 cents. That's just fuel eating away at that gross rate.
Throw DTS on top of it, Will, and do the dual chart. So DTS, of course, our daily retail diesel price based on this data set. And it's very fast. It's much faster than most fuel surcharges move because it's daily.
Well, fuel surcharges are weekly.
You see the inverse correlation.
And just do a 6 months on that, Will, because I think it's easier to see it over time. But you basically see where these pass, and as this goes up, that's going to go down. It's the way it's supposed to work. But it doesn't tell us anything about the clearing prices in the market. Ultimately, brokers are still going to pay $2.82 a mile. Shippers are still buying capacity at those high rates. There's been no deterioration in the gross clearing rate in the market. Like I said, the NTIL rate is good for people looking at the cash flow of a motor carrier. And over time, it really is relevant. And we saw it during, like if I want to know an inflation-adjusted take-home pay, then I will look at NTIL. But if I really want to understand the market dynamics, this is an irrelevant fact, as is truck stops rate that's inside of Bloomberg or DAT's net of fuel. It does not matter because it's not a clearing price in the market. And that is the biggest difference here, and it's something that has to be understood. And so we've seen all of the transport sell off aggressively. I think, Knight Swift and some of the big truckload carriers are almost 20%, which the data does not support that at all. In fact, let's go to volume, because this is one of the questions that we get talked about. Is rejection rates are high, and really the conditions that would take rejection rates high is going to be tightening capacity, and look, we're going to talk a bit about compliance, the compliance crackdown that's been taking place. That's the reason the rejection rates shot up over the summer or over the fall was the compliance crackdown and removal of excess capacity, but also demand. But I want to point out demand here, and look right here. The SONAR truckload volume index is the highest level we've measured in a year. But let's go to a 5-year chart there, Will. This is the highest level that this index has picked up all the way since 2022.
Right.
In terms of volume of tenders. And that tells us a lot about the fact that demand is also, so rejection rates are high, but demand is also coming in to reinforce the market. And I think that tells us that this market is not being negatively impacted, at least. If you zoom in on that.
It's important too. Like we actually have been this high in this cycle. And in 2024 in July, we actually had fairly high demand.
This was the highest we had seen. And we are touching that level. I think that's because of the
But rejection rates were not close to where they are today.
That's correct. And so we have tightened capacity. We have volumes that are sustained. But do a seasonal chart. I think it's even more interesting to look at this on a year-over-year basis, because I think this tells us a lot more about where we're at. Look at where we're at last year, Zach. This yellow line is 2025. That blue is where we're at. We're up approximately in terms of volume of tenders about 10%. And again, this is mostly contracted freight. It's not picking up the spot stuff. We do get asked, and I think we should just go point it out, are these subsequent tenders that happen, and you can pull up an index called CLAB. You like it a lot better than I like it. I don't like it that much because, yes, it gives you a pure play of taking out the subsequent tenders, but it doesn't measure the spot activity.
No. It probably understates demand to a certain level. In a high rejection rate environment, it probably significantly understates demand because some of these tenders are getting accepted down the line or outside of the route guide.
Or it's flowing into the spot market.
The STVI is probably overstating demand a little bit. And so there
are no perfect answers.
Here. The answer is probably somewhere in the middle. But I think the value of looking at STVI in this environment is knowing how quickly demand is changing. And how quick you're going to see those route guide failures.
I agree.
So I think too, calling out the fact that last year was a pretty bad volume year.
It was a horrible year. I mean, look, and it all started in February. This is that 51st state nonsense and the whole UMCASA tariffs and Liberation Day tariffs. The comps are really hard. I mean, if you go back to April, this was really during the Liberation Day tariff.
Easter has had a bigger impact.
I mean, you saw it in April. You saw it dip down here. You're right. Easter always, and it moves.
This was the first kind of
holiday that moves.
This was all that USMCA stuff.
So that was a real rough. It happened around it happened early February, but really felt it around Valentine's Day. But with the comps, we haven't had that. Now we have this Iran war that's going on, which is a big conversation that we should have. Is the impact of the Iran war? And look, this is an uncertain period. This is unprecedented. Don Kingston pointed this morning, who's our big energy oil writer and reporter, arguably one of the smartest oil reporters.
Knows his stuff.
in the entire market, talks about the fact that the Dubai oil rate is an assessment of oil out of Dubai is like $170 a barrel. It was the highest he had ever reported. And he was talking about his history of being at Freightways. He reported the negative $26 a barrel and 170. It's like a bookended two extremes, which is exactly what we're seeing right now in the economy. What's interesting about it is there was a little bit of pause in the volume around the start of the war. And you could see that, see this blue top, kind of paused. And, I remember looking at it, and we talked about this, I think, last time we were together, which was, does a war with Iran, this was, a month ago, was theoretical,
Right.
Will it negatively impact trucking and negatively impact the freight market?
Right.
And nobody knew at this point whether it was going to happen.
Right.
And we certainly didn't anticipate what's happening with oil. But what's interesting about it is in looking back through history, every single time we've seen a military conflict that the U.S. has been involved in, it has driven more freight demand. Now, someone on X challenged that thesis and says, but the OPEC crisis, the Yom Kippur War, was the one they were using as a reference. And I pointed out the U.S. was not directly involved. I'm sure the CIA was, but that's a different story. The U.S. was not a participant in that war. That was Israel. And the second is, it was the repercussions of the oil embargo is actually what hurt the economy, not the war itself.
Right.
And so if you look at the types of things, I mean, the Trump administration is asking for $200 billion more dollars to fund the war effort for the Department of Defense. Huge amount of money. I mean, you're talking about 20 or 15 to 20% of the overall defense budget being added. And that's all for rebuilding stockpiles of weapons. Those things do drive freight. Yeah. Also, I think the oil market instability, even if we see a ceasefire and we see more sort of smoother waters, I think the damage is done in the psychology of markets, particularly for places like Europe and Japan that are or Asia that are far more vulnerable.
Sure.
I think it's going to spur U.S. oil investment.
Well, it's going to keep the price of oil high.
It's going to keep it high because you have the geopolitical premium, but you also have more confidence in the price of oil staying higher, which will drive U.S. industrial investment.
Right.
One of the interesting data points, it was an article yesterday, because Todd Maiden wrote it, was that the American Association of Railroads had a surprising increase in rail volumes year over year by 6.5%. No one saw that. In fact, if you go back and look at the earnings calls of the railroads in January, they're all pretty bearish about this year. In fact, I was getting a number of people, as I was becoming more bullish about volumes, people were referencing the railroads saying, how is it that they're negative and you're not? And they clearly have found more constructive volumes than they expected.
We talked about this last time. The ISM actually had a fairly bullish, for lack of a better word, like data read. Like we saw this uptick in CapEx. I've heard it on the financial channels as well. And the rail volumes actually were okay in January, but the sentiment behind it was fairly negative.
They were pretty bearish. Yeah. And I think the railroads, and I've said this to a lot of people, because even if you look at some of the trucking companies, J.B. Hunt gave they're always the first to go as sort of the bellwether. They were not overly bullish about the market when they gave their earnings call in January, and some of the other truckers were a little bit. There isn't a lot of advantage of going out and being super bullish.
After 3 years of...
If you're it's true. It's like sticking your head up these green shoots. But that's what I've told people is like, look, it's hard to read it. I'm not challenging the fact that they don't know what they're going to, that they're being disingenuous when they talk about the market. I think they're far more, if you're a public traded CEO, you have to be careful what you say, because you can't get ahead of yourself.
Right.
And so for them, comment out too bullish could be negative if they're wrong. And so they're going to downplay a lot of the developments, let the market kind of develop on its own. In fact, their stock prices were already on fire.
Yeah.
So it wasn't a whole lot of upside for them to be overly
I think
bullish.
you make a good point here, though, in the sense that the financial markets tend to be, and people like us tend to be very on the spot, like in the moment. Whereas a lot of these companies and corporations don't get any benefit.
Well, they're more
of that.
measured.
Yeah.
They're definitely more measured, and rightfully so. And I would be likely if I were a CEO as well.
Absolutely.
Because there isn't a lot of advantage of getting ahead of the market and coming out super bullish and then something not happening. So I think that's a lot of what we're seeing is there was a lot of conservatism built into the conversations. It's interesting if you read a lot of the analyst reports, is when they were talking to private companies, much more bullish sentiment than you get with some of the big public ones. That's just the nature of financial markets. And anyone who's ever been in the seat of a C-level executive at a big public company, naturally they're going to be very measured. That's part of the 101 training they give you when you go public.
Yeah, everything has to be a little calculated. So, Will, let's pull up the flatbed, the FTI, RTI, NTI together on a chart, because I think it's important. You're just talking about manufacturing, the energy sector, huge clear-cut tie to oil production here in the United States, which is a net exporter of energy now. Something that's interesting, you called out on Twitter a few times here, the flatbed space seems to continue to be, and I think this is probably going to continue.
Well, look,
based on what you just said,
this
right?
blue is flatbed, this refrigerated is green, and the van is
Fuchsia.
Purple. Not fuchsia.
Yeah, it is a little more purple.
T-Mobile would be disappointed in you. That is purple.
I'll give it to you.
Horned frogs.
Your favorite team. But the flatbed rate here in blue taking off still, and this has been a market that has been, normally we see flatbed rates actually above refrigerated. So refrigerated there in green, and the flatbed market was really quiet last year, and it has taken off in an unseasonable time of the year.
It was quiet because housing is a dog. Like housing, even this morning, housing starts.
To be.
Well, it used to be, when we first started tracking this data in 2017 and 18, housing drove the flatbed business. It was all housing,
right?
Or mostly housing, even though that's not everything that's hauled in flatbed is housing related, but it was driven by the nature of flatbed was largely tied to housing. That is no longer true, or is not true currently. Housing's a dog. In fact, new home starts this morning, I think, I was listening as I was driving in on Bloomberg, and they were down something like 17,000. They were projecting. Anyways,
not a good market.
Not good. I don't remember the exact number.
Yeah.
But housing's not good. Yeah. But there's something else driving it, and it's hard to get to the exact commodity of what it is. But it is coming from the industrial Midwest. It's coming from the Rust Belt.
Right.
It's coming from old school machinery.
Yeah.
And it strikes me that things like steel, aluminum, copper, that is what's driving this market. It is largely related to some of the energy build out, and I'm not talking oil and gas, although at some point that will be a factor. I'm talking about the power generation, the cooling systems going into data centers, the data centers themselves. When you're building a data center, the chips are only one piece of it. It takes a truckload tons of copper.
It's not just a big pile of chips on top of each other?
And no, there's a lot of stuff going into that. You got a lot of copper wire for power. You got fiber going in because all these data centers, fibers are. And so you have a ton of, you have the steel racks. It's a lot of that. And that is what's moving the market. And so I do think AI data centers are a piece of it. It's interesting because when you post that on X, people are like, well, it's just AI. I'm like, it's still a demand driver. You can't discount that. And it's good for domestic manufacturing because it doesn't matter where it's coming from, it is coming from.
Yeah, it's a lot of construction activity that's not housing.
And it's not import. By the way, the other thing that I should be very clear is the semiconductors are coming in from overseas, clearly, from Taiwan. That's why Taiwan now, interesting data point, Taiwan's export volume to the United States is bigger than mainland China, dollar-wise, not volume, sorry, volume, dollar-wise, because those chips are very expensive. I was about to
be like, we'll pull up IOTI.
No, it's very expensive. And so the dollar to exports to the United States is bigger than China. Crazy stat. But it's all that semiconductors coming over. They're coming over for Asia, and they're putting it in data centers. And to build a data center, you need a lot of concrete, need a lot of steel, need a lot of copper, need a lot of metal. And that appears to be what's driving it. Plus, we're seeing like agriculture, farming equipment, John Deere and Caterpillar have been constructive to.
There's some capital expenditure
there is some capex, and there's some big tax benefits to some of that. Some tax bill changes this year that have been driving some of it. But generally, I would say on a volume side, I feel pretty good about the freight market.
Yeah, and I think we've got obviously like the general market conditions, since you see all three of these trailer types showing that upward momentum. Flatbed, of course, is getting a little bit more of a tail right now.
Van is the most commoditized.
Van is probably the most voluminous.
Well, it's the biggest part of the market. It's also the most commoditized. There are significant, like if you're adding trucks, you're going to mostly add it in the van market, particularly smaller players. Flatbed tends to, I think JP has pointed this out, is that flatbed tends to be a little bit more experienced drivers. It's a harder job being a flatbed operator. And so it's not as attractive to people that are not as seasoned or as veteran. And refrigerated just more expensive.
Yeah.
It's a more expensive part of the market because those reefers take a lot of money to run.
Yeah, roughly 20 to 30% of our tender data set is refrigerated. That market's more fragmented as well. You got a lot of niche operations. We're about to head into produce season.
Produce season is good. It starts in,
But we've already seen produce rates start to tick higher in front
well,
of
that's
this
tight
cycle.
capacity.
Yeah.
That is tight
That was going to be
capacity.
my point.
I want to talk about the compliance crackdown because it's the most important piece of the story. So we've talked about volume. Volume is a huge contributor to the freight market right now. It's
Right.
keeping it there. But it's coming into the backdrop of very tight capacity. And this is what happened over the fall. Let's take two charts. Let's do tender rejections, Will, and OT. You can go OTRI and OTVI if you'd like. And I think what's interesting is that as rejection rates increased, we didn't see
This is one of my favorite
volumes
charts.
were not real robust,
Yeah.
but there was started to be, but they're much more in line. You see this gap much more in line. Now those higher volumes are certainly pulling on rejection rates.
Do a 2 years on this. Go at least 2 years back. Do a 2024 on this because I think this shows your point really a lot more cleaner over the course of time. And correct me if I'm wrong, Craig, but this right here, this red line is demand.
Yep.
The blue line,
Volume.
It's volume. It's coming down.
Yep.
Tender rejection rates, which is kind of that, that's the answer to the supply and demand curve in trucking. It's kind of crawling higher while demand is coming down, and then all of a sudden, pop.
Well, I think this was the inflection point,
Yeah.
right? Is that you started to see that really in the fall, it happened in the fall. The compliance efforts really started to take place in that July, August period.
Yeah.
And then we start to see rejection rates trend up and just continue to overshoot in many ways volume. And that is why rates are on up, and that's why contract rates are going to come up during this bid cycle because they have to. Now, shippers are getting hit twice. They're getting hit from higher contract rates, which feel inevitable, but then also higher fuel surcharge rates because of the high price of fuel. It's a miserable time to be a shipper right now.
In terms of getting that inflation shock, right?
It is definitely.
Because you're actually getting worse service on top of that.
Of course you are, because there's just less trucks.
Yeah.
And the compliance, it's interesting. I was telling somebody that, describing the situation around compliance, and I said, look, here's the thing. At the end of the day, if you're a freight broker, and this is going to be a very controversial statement, I'm going to make it.
Let's do it.
Is not that that's unusual.
Okay, yeah.
But the non-regulated, non-compliant motor carriers provide better service and cheaper rates. And the reason they provide better service is because they can run 20 hours a day. Like they run nonstop and they'll run faster.
Which is illegal, by the way.
It is illegal. And by the way, it may not get there safe. There are missiles driving down the highway at 80,000 pound missiles. The nice thing is a missile will get there really quick.
Yeah.
But it also may end up killing somebody along the way. And that's where the compliance question comes in, is like, if you're a broker and you've been taking advantage of a lot of the non-compliant carriers, you've been getting better service, arguably, from a time.
Lower rates.
And better from point A to point B, because these guys will run 20 hours a day, whereas a legit carrier will run 11. By the way, I'm not endorsing that because that is a bad thing. But I'm saying that's exactly the way the market's been working. From a psychology of a broker, I can get this from point. It's the strong solo Sergey meme. They have a meme about this because it's true. And what's happened is the administration is really cracking down, rightfully so, because we've had a two-class system. We've had a system where carriers that have been operating compliantly, have been following the law, have been struggling mightily because of the conditions of the freight market. And carriers that have no regard for the law, who have been breaking almost every rule in the book, have been profiting mightily. And this is all changes. The administration is really cracking down. There's a new law, and with that, I want to invite JP Hamstead. He's our chief economist. He also runs our Freightways Media editorial product. JP, Delilah's Law was something that was teased during the State of the Union address by Donald Trump. It went through committee yesterday. It did pass committee along party lines, as I understand.
Yep.
It is now going to go to the House, is that right, for vote?
It passed out of the Transportation Infrastructure Committee along a party line vote.
Is it the House or the Senate?
House.
Okay.
Yeah, so this bill really combines two kind of separate but related concerns. One of them is English language proficiency, and one of them is like the non-domiciled CDL driver. So on the one hand, with English language proficiency, it makes it much more strict, the requirements that states have to follow in granting the CDLs in the first place. Like, so for example, all CDL training and knowledge, all the skills training and assessments that go into the awarding of the CDL have to be conducted in English. That wasn't the case before. Truck
We have
drivers.
this data here. If you go back, Will, do a 5-year chart on this. It's not going to matter. But this was so. By the way, the English language proficiency rules have been on the books since the 30s.
Long time.
But they were not enforced up until
Last year.
June. And that's where Duffy started to put out the rules on English language proficiency. And we're now down, about 86 trucks are put out of service per day. But Delilah's law will basically make this a permanent.
Makes it a permanent thing, and if it requires the states to sort of like audit their CDLs and things like that. And the other thing it does on the non-domiciled CDL side is that it requires, basically only American citizens, lawfully permanent residents, and foreign nationals with specific work visas can be offered CDLs. There are lots of people running around the United States that have CDLs that aren't legally in the country because they have expired visas or they're not citizens or whatever, or their citizenship status was never tracked when they first applied for their CDL. So all of that's going to change. This Delilah's law sort of accelerates and intensifies some regulatory changes that were already happening that the FMCSA was already doing. It pulls a lot of that forward, and it's basically trying to clean up all of the non-domiciled CDLs within a year.
Well, I think there's a couple of things that are important. One is it codifies it in law so that a future administration will not have the ability to overturn it without going through Congress.
Right.
It literally takes an act of Congress,
Right.
which is
Few
a
and
hard
far
thing
between,
to get.
yeah.
And so it's unlikely that so it makes it permanent. It also makes it less likely to litigate. So there's been a lot of lawsuits that are out there. They've been trying to get the judges or the court systems to determine that this is unconstitutional or illegal. And so that if it's codified in law, then the judicial, unless they can prove that the Supreme Court says it was unconstitutional, which
It's a lot higher bar for the judges
and so
to
it
strike
makes
it
it
down.
far more likely to be real.
And it also-
creates penalties for the motor carriers that violate it, which I think is interesting.
Yeah.
And probably the most important piece, there's two other pieces of the law that I want to point out, but one of the most important things that it does is it takes the 5-year when the FMCSA came out with its final rule on non-domiciled CDLs, it gave them a 5-year window. And this
It
under
was going to let
Delilah's
them
law-
expire naturally.
Yeah, so up to 5 years. So let's
yeah.
just be clear. If they were expired before that, they would be expired. But it was up to 5 years. But this actually says it's a 12-month clock. So puts everybody on notice from the date of that law coming into effect, it would actually make it a 1-year time frame. It standardized the CDL issuance. The other thing it does, which I don't know is actually that enforceable, from my opinion, and really going to be an impactful. Truckers love this, though, so I should point it out, is it makes offshore foreign dispatch operators or dispatchers and foreign brokers, it makes that illegal unless you're in Mexico, Canada, the United States. How do you enforce that? I don't have a clue.
Yeah.
To me, it's something that was added into the law that feels like it's a great give for the truckers. Questions of enforceability, I don't know. But it was interesting that it was put in there.
That is interesting. I would say the other big part of Delilah's law that's really important are the penalties that states themselves can suffer if they don't clean up the way that they issue CDLs. In the first year, I think the federal government is saying that they can withhold 8% of the highway apportions appropriations to a state, and then after that, it goes up to 12%. So there's a pretty big
Hundreds of millions
stick,
potentially
that
and billions
come
of
along with all
dollars to
this.
the states.
Right.
So it's an interesting thing to watch. The one thing that I think everybody's watching right now, JP, is the Supreme Court has this case in front of them. Actually, there's a couple of cases around brokerage transparency. It didn't make it into the Delilah law like I think the father wanted it to. It was not in at least the House version of the law. The interesting thing around the brokerage transparency, or not transparency, but brokerage liability question, is this high idea that brokers cannot be sued in the event of an accident of a motor carrier that had some negligence or had a safety issue. This is in front of the Supreme Court. If that passes, it could be demonstrative to the freight brokerage industry. It could have a massive impact.
Yeah, it could. I mean, it's interesting. It doesn't really get to the real problem, I think, with the market itself, which is that if a broker is sort of like buying and selling goods in a marketplace, they need to be able to trust a government issued CDL. They need to be able to trust like an insurance certificate on a carrier. They need to know that these sort of mark an actually fungible commodity, and that there aren't, that it's not up to the broker to do extreme amounts of due diligence. The example would be like an oil trader, buying and selling futures. And then someone goes up to them and says, well, hey, did you look inside the barrel?
Yeah.
Is the oil actually there? It's like, well, no, that's not my job. I'm trading this commodity that's highly regulated, and I trust that the regulations do what they say they're going to do.
I think the important part of that is that brokers are trained and taught not to actually go deep. It is designed, the way the system is designed,
plausible deniability,
is they don't want to know. I was explaining this to someone who's not in trucking. Why? Because everyone likes to assume that there's like this evil out there and these parties are doing things at a nefarious action. And I was explaining, look, a lot of this is because to protect themselves, is the trial attorneys are looking for any reason to go after anybody they can that has any level of money. And if they can prove negligence on the part of a freight broker, they will go after them, sue them. So a lot of brokers are trained to not ask the questions that would actually determine whether these truckers are compliant, because they're operating in the framework. That's the government's job.
Yeah.
Whether you believe that's the case or not, it is part of the system. So don't hate the players, hate the game. The reality is the Supreme Court could completely overturn that. And if it passes, it'll have profound impacts on smaller motor carriers, because that's where they get their freight.
And basically what's going to happen, I think that the shippers and the 3PLs will enforce just much higher requirements, and those other parts of the market that we were talking about, like insurance and stuff, will have to come along for the ride.
Well, the reality is that freight brokers, if it does get ruled that freight brokers can be liable, then the question that I've talked to a lot of people, legal analysts in this, the question is how hard or how easy would then it be to loop in the shippers into that liability question as well. That is a different conversation for a different day. But all of this to say, I think bottom line is compliance crackdown is having massive impacts, Zach, on this market, and it's not going away anytime soon.
Yeah, well, we're running right up into our Q&A segment, so obviously we need to get some
thank
questions.
you.
But
Yeah, thank you.
yeah. So, Brielle, let's hear what they have to say, or ask.
And so if you haven't already submitted your questions, please type those into the Q&A section of your webinar console now. We do have several that have already come in. We can start with, how do you think the fuel price increase is going to impact contract rates that shippers and carriers are negotiating right now?
Yeah, so I think fuel is going to be a big piece of the conversation. I mean, fuel surcharges is what it comes down to. I don't know that we'll see anything change, but I think it does place pressure on contract rates. It's going to be just one of those things that shippers are going to be cognizant of when they start awarding freight out.
I could give a dissertation on this coming from pricing. So, Will, let's pull up VCRPM. There's two things at play here from my perspective as a pricing analyst, former pricing person. We're already seeing upward pressure on contract rates. So this is the average dry van contract rate. This was largely flat for 2 years. We really didn't see a lot of upward pressure, and it's taken a lot of energy to increase this rate. So what's happening here, a lot of this increase is simply transportation costs, the value of transportation services has increased or inflated.
Well, this doesn't have fuel embedded in it. This is contract line haul.
Exactly.
And it does not have fuel in it. $2.45 a mile. This is all reflective of the tightness of capacity. Fuel surcharges will be on top of this, but it's going to certainly blow some budgets out.
Yes, but contracts, because this is the component, most shippers require, this part of the cost to be independent of the fuel. What's going to happen, depending on expectations for fuel volatility, is pricing departments will push some of that that fuel volatility into the price, or maybe they'll remove it from the price because they're getting it already from the fuel surcharge. So it's going to create a little bit of play.
By the way, I think if shippers have been caught off guard, and we know some are, with how capacity is tightening, theoretically, they have been given a massive gift. Now, it's hurting their budgets and maybe their bonuses, but from a going to management and being like, I'm screwed, I'm blowing my budget, fuel gives them a really nice out to, because it's a chance for them to explain to the corporate management, I didn't miss my budget, it was all fuel related. And I bet that's going to be, anyone who's missing budgets is going to be blaming it on fuel. There's
nothing you can do about it.
I can't, this is out of my control.
Well, so this is fuel, this is regardless, this doesn't have fuel in it, transportation costs.
It doesn't, but remember,
pull up
most
NPG.
Most CFOs are not looking at the components.
Right.
Most CFOs
are looking at the total.
Are looking at the total cost of transportation.
But here's your out right here.
Right here.
Your average cost per mile here.
53 cents a gallon, or 53 cents a mile, and fuel to 73 cents.
Yeah.
Now, it doesn't explain all of the cost, but that does give you, you at least have some air cover. It's just like in trucking, every January, it's going to happen on these quarterly calls, because we're going to hear all the public trucking companies, they're all going to put weather in their earnings reports, because it's always the way that they can save face when they miss a number. Hey, this massive winter storm cost us X number of dollars.
But 20 cents per mile in a matter of a week and a half, 2 weeks is significant.
I don't know.
Hard.
Go to all, Will. Have we seen that other than maybe COVID with the
Ukraine?
extremes?
Russia,
I
Ukraine.
guess Ukraine was higher, wasn't it?
But the market was collapsing at this point.
No. This was, remember, Ukraine was here. Ukraine here to here. No. It was in February.
This was it.
Is that February? Yeah. I guess you're right. That is February. You're right.
So, but the market was collapsing at this point.
Yes. Sorry.
Remember, this was the great start of the Great Freight Recession.
That's right. Fuel was definitely
getting hidden.
Yeah, and the carriers were getting totally creamed.
Exactly.
Awesome. The next one is on the topic of the Iran war. Which sectors might be be most exposed if this persists for an extended period of time?
It's a great question. I did some math on the impact to consumers. So gasoline prices, maybe a week ago, had only gone up something like 70 cents a gallon nationwide. The average consumer, it's a big number, but it's still much lower than where it's, what diesel has been more reactive than that. But it wasn't as big of a number as I expected. But the average consumer impact on an annual basis was about $360 total. Now, it's probably a little higher now because oil has gone up since I did this math. So we're talking about $350, $400. The vast majority of consumers that are driving retail goods are in that we've known that the upper end of the market, this K-shaped economy, is not being impacted by inflation. They're not being really obliterated by...
Not as much as the lower end.
Correct. It's the lower end that are going to be the most vulnerable. And so I think consumers may pull back in that. But one of the things that JP and I were talking about is that while consumers may pull at the dollar spending, they are trading down to different categories. And so they still have to eat a meal. In terms of the volume of goods consumers, in terms of volume, doesn't change a whole lot, but what they spend money on will. And so they may cut back on discretionary spending for like travel. They may cut back, but even in recessionary periods, this is an interesting stat from 2008, we actually saw more consumption of snack goods and soda, Cokes and Diet Cokes and stuff like that. Consumers tend to spend more on stuff at home, incremental low-cost goods, and ultimately, so in terms of volume and consumers, I don't think it's negative. I do think there's a positive. In fact,
What about like home furnishing stuff, like furniture,
it's
electronics?
discretionary. If you had a house, nobody's
Yeah.
buying homes.
Exactly. Okay.
So that's not going to make a difference. Cars, no one's buying cars. In the upper end is.
Yeah.
But general consumers that are really at the lower end of the market are not buying these things.
Right.
So it's not going to really make a huge difference. But there is some, Citibank actually had a report yesterday that came out that talked about that they believe that the war will actually be a medium-term stimulus. And they were talking about oil service, exploration, new oil equipment going in to build out military and defense. They were actually, their prospectus was that could potentially increase demand, not hurt it. I think the question is, obviously manufacturing, industrials, it's all demand driven. A lot of what's driving the industrial demand we've talked about is data center.
Yeah.
Data centers are priced, the cost of building a data center because of higher oil prices it's not going to change the calculus.
No.
They're so capital.
Sure.
Like that is a very small portion of the overall build out of a data center is in the stuff that's impacted by oil.
Yeah.
It's the chips that drive the predominance of that cost.
Yeah, the energy, like we've seen this in the past, where the price of oil actually drives a lot of industrial manufacturing activity, and in the long run, it can
increases.
actually stimulate
As the United States, and
economy.
there's this all and then John Kingston, I'm sure would report on this, is that there's the big price delta on Brent, which is the international benchmark, and WTI, which is the domestic benchmark, and that spread continues to get higher because U.S. we're a net exporter of oil and a lot of natural gas, and therefore we're not as impacted as global markets. It actually makes relative competition.
Right.
It makes U.S. industrial manufacturing more competitive than global, even if the global manufacturing and global economy gets really negatively impacted, U.S. manufacturing is somewhat insulated because the energy supplies.
Right.
Even if prices go up, still we have availability of energy.
Yeah.
Countries in Asia, particularly poorer ones, that they're actually, there are shortages, fuel shortages. I think the jet market has gone absolutely hyperbolic throughout Asia. And so those are things just to watch.
Right.
So I look, does it have a negative impact? Yes, but I don't know how significant on freight.
Cool. For the next one, this person would like to know if you guys are able to elaborate on how rejection looks by region.
Oh yeah, we are. You want to pull up?
Yeah. Pull up the map.
Pull up some maps there, Will. And let's go.
That's the hull map. So let's pull up OTRI or STRI, yeah. There you go. Look at that blue in the middle.
Okay, so deep blue is better or higher rejection rates.
Higher tender rejection.
White is lower. So think about this. All in that Midwest. We talked about the Rust Belt.
Yeah.
A couple of weeks ago, it was a little deeper here. It's moving to that I-35 area where we're seeing high rejection rates. Really, the Midwest, that I-35 is where we're seeing it. So big auto plants, Kansas City, St. Louis has got some, Detroit, all of that, big heavy machinery, farming machinery. All of this is.
But these are also tough areas to go into a lot of times because they are fairly sparse out here.
In terms of freight?
In terms of freight.
Yep.
And it's inconsistent freight at that. And I think that's what a lot of carriers are struggling with right now. Although we have seen some higher rejection rates in some freight dense corridors too.
Yeah, but you know what you don't see is the coast.
Except
Savannah,
this is.
Southern California, Newark.
We'll pull up the WRI map because this is changing, and I think this is important to call out right now. Do WRI, and over the last bit, we're starting to see some blue percolate here.
Yeah, red is where it's declining, blue is tightening. You're starting to see it in some of the ports, and all of this is seasonal, right? Because the Chinese New Year was a couple of weeks ago. It takes a couple of weeks for freight to move after the Chinese New Year as they resume their sort of economic activity, and so the coasts have not even been participating.
But you see, we're getting, even though rejection rates are high, they're starting to settle out.
They're cooling here, but they're strengthening there. But generally across the country, that's a positive thing.
It's kind of a trade-off.
Awesome. I think we've got time for one more question. I thought this one was cool. At what point do oil prices need to get to where freight would switch to rail?
I mean, I believe it's already happening.
Yeah.
The rail surcharge is at a different cadence. This is part of Citibank's report, is that they do monthly surcharges. Trucking tends to do weekly. So there's this lag that will negatively impact the railroads short term. That's one thing, but also the delta between intermodal fuel and trucking fuel, call them accelerators, are much higher on the railroads because they're more efficient. And that's actually an area when you see a big spread in intermodal and truckload, you see more intermodal volume.
Yeah, and, well, what did we just talk about? The Midwest, the central U.S. is the portion that's getting the most.
I mean, look at that
the
spread.
highest level of rejection.
$1.31. You pointed out, and I posted it, that it's almost like the railroads have been sleeping around this truck thing. I have a theory on this.
Well, I actually talked to Mike Bowdenisle about this,
What's the
and
story?
he said that it's because there's intra-competition in the industry that's keeping those rates subdued. So your participants in the intermodal space are trying to compete with each other for
I
share.
believe that, but let me tell you why I think it's also they're not being as aggressive. There's a major merger between UP and NS. And if one of them is not driving higher rates, the other one can't do it either. If that inter-rail competition is so significant, and UP is like, look, we're going to play low key right now. We're going to let this thing happen. And they're kind of waiting out the competition. Then BN can't increase rates either.
And they don't have to.
They're making so much money on intermodal volumes there. I mean, this is the rate spread of $1.31, but if we pulled up volume, you can see that the intermodals have been sitting out the entire freight recession.
Yeah, and they're not raising their rates. As a pricing person, this is hard for me to deal with. But the fact is, if they have excess capacity,
I want to do a seasonal chart on that. Well, I want to show you this because this is what intermodal has been looking like for the last couple of years. Is look at this. I mean, this naturally
23.
falls on normal market. Well, not our market, but like way you would expect it. 2023, 2024, 2025, 2026.
They've been playing market share games for the last 2.5, 3 years.
And they've said that.
Yeah.
And they said that even their earnings calls, the big railroads have talked about there's going to be a chance to get share from truckers.
Yep.
And you saw this in the February reports that the intermodal volumes were higher. Again, the rails did much better than expected.
Right.
And I think it's just a sign that the market's better than what a lot of people expected it going in this year,
100%.
which is great.
Excellent. Well, that is all the time that we have for today. A special thanks to Zach and Craig. Thank you guys for being here this afternoon. It's always great to have you sharing your insights with us. And as always, we appreciate our audience as well for always joining us for these events each month and asking such great questions. FreightWaves is bringing you some events over the next couple of months. We do have the Small Fleet and Owner Operator Summit, a virtual event happening on April 23rd. And we have the Freight Fraud Symposium coming up on May 20th in Cleveland, Ohio. You can register for our events at live.freightwaves.com. And don't forget to mark your calendars for the next State of Freight on Thursday, April 16th at 2 p.m. We can't wait for you guys to join us again soon. Thanks, everyone.